The market just delivered a masterclass in human psychology disguised as price action. While everyone debates whether we're heading for a Santa rally or a year-end sell-off, they're missing the real story unfolding right in front of them. Last week's whipsaw from a powerful 5% Nasdaq rally to Monday's sharp reversal wasn't random market noise. It was the system exposing a fundamental truth about human nature that creates exploitable opportunities for those disciplined enough to see it. If you've been watching the AI trade fragment wondering why Alphabet surged 14%, while Nvidia dropped 13% in November, or questioning whether this Fed pivot is real or just another head fake, then you need to understand what's actually happening beneath the surface, because the crowd is making the same predictable mistakes they always make, and the disciplined minority is positioning accordingly. I'm going to show you exactly how to read these signals through the lens of human behavior, systematic thinking, and Stoic discipline. By the end of this analysis, you'll understand why this volatility is not chaos, it's recalibration, and it's creating the exact conditions that reward patient capital. The past 2 weeks revealed a market caught between two competing psychological states that every trader and investor needs to recognize: relief and exhaustion. After that brutal mid-November drawdown driven by AI valuation anxiety, participants experienced what felt like vindication, a sharp snapback rally fueled by dovish Fed signals. But here's what most missed. This wasn't conviction buying. This was classic mean reversion behavior dressed up as fundamental analysis. The 80% probability of a December rate cut became the narrative anchor that allowed traders to rationalize re-entry into beaten-down names. Human beings need stories to justify their actions, even when those actions are driven by pure positioning dynamics. Then December 1st arrived, and the fragility was exposed. When Bitcoin cracked below 87,000 and crypto-linked sentiment soured, we witnessed the reflexive flight from risk assets that demonstrated just how shallow that conviction really was. This is textbook loss aversion meeting FOMO. Those who missed the 2023 to 2024 rally fear missing the next leg, yet those sitting on gains fear giving them back. The result? Choppy, headline-driven price action with compressed time horizons. The 138-day streak above the 50-day moving average ending in November wasn't a technical anomaly. It was a signal that the easy money phase had concluded. Participants now face a regime where volatility is the cost of participation, not an exception. This human behavior created a systematic response that's both predictable and exploitable. The system absorbed these conflicting signals and produced a coherent output: risk-on exhaustion followed by tactical retreat. That late November rally was mechanical, not organic, short covering, systematic rebalancing into month-end, and Fed rate cut repricing after Williams and Daly signaled dovish intent. The snapback was driven by positioning, not fundamental reassessment. When breadth improved temporarily but remained fragile, it told us everything we needed to know about the underlying structure. Consider the concentration risk. The top 10 names now command over 40% of S&P 500 weight. When these names falter, the index follows. This isn't a bug, it's a feature of winner-take-all dynamics in technology. But concentration creates fragility, and that fragility creates opportunity for those who understand the game. The sector rotation into rate-sensitive areas, retail up 4%, home builders up 4%, regional banks up 3%, was rational given the Fed pivot narrative. These sectors had underperformed and offered asymmetric upside if cuts materialize, but the rotation lacked follow-through on December 1st, telling us participants are testing rather than committing. Here's where it gets interesting. The crypto sell-off acted as a real-time liquidity signal. Bitcoin's drop and broader digital asset weakness indicated risk appetite was contracting, not expanding. This spilled into AI-linked equities, with Nvidia, AMD, and Broadcom all declining. The correlation between crypto and high beta tech remains intact, serving as our sentiment gauge. The macro backdrop reveals the same pattern. Jobless claims at 216,000 suggest labor market resilience, and Q3 earnings growth of 13% confirms corporate adaptability. Yet the Fed's decision to end quantitative tightening while maintaining restrictive rates creates a policy paradox. Liquidity conditions are easing, but the cost of capital remains elevated. This supports asset prices near term but compresses forward multiples. The technical picture shows exhaustion at resistance. The S&P 500's failure to hold above 6,800 after multiple tests indicates supply is overwhelming demand at current valuations. Markets that trade above their moving averages for extended periods without correction tend to experience sharper drawdowns when the trend breaks. The system is now in consolidation, digesting gains and repricing expectations. But here's the crucial insight that ties everything together. The market is teaching the same lesson it always teaches. Price is the only truth, and everything else is narrative. The November volatility wasn't a crisis, it was recalibration. The AI trade experienced its first meaningful stress test since the 2023 breakout, and the result was entirely predictable. Weak hands exited, strong hands rotated, and the structure held. Nvidia's 13% decline and Supermicro's 35% collapse weren't systemic failures. They were valuation corrections in names that had borrowed excessively from future expectations. The Fed's dovish pivot isn't a gift. It's a response to deteriorating conditions that haven't yet fully manifested in the data. The 80% probability of a December cut reflects market pricing, not certainty. The Fed operates with incomplete information, and this creates the exact uncertainty that disciplined investors can exploit. This is not an environment for heroic bets, it's an environment for process. The concentration risk in the S&P 500 exists because the top names generate disproportionate cash flows and possess structural moats. The solution isn't to avoid them, it's to size positions appropriately and maintain exposure to uncorrelated assets. The crypto sell-off reminds us that speculative excess always unwinds, but those who treat digital assets as long-duration options on monetary debasement rather than momentum trades will be rewarded. The earnings picture remains the most important signal. 13% blended growth despite tariffs and higher costs demonstrates corporate resilience. This is the foundation of equity returns, not Fed policy or sentiment. The Stoic approach is clear. Volatility will persist because uncertainty is structural, not transient. The market will oscillate between risk-on and risk-off as participants react to headlines. The disciplined response is to ignore the noise and focus on the signal: earnings growth, valuation, and liquidity. The system rewards those who manage risk and punish those who chase performance. The market isn't an adversary to be defeated. It's a system to be understood. Those who approach it with humility, discipline, and patience will compound capital. This is exploitable because human nature doesn't change, but most participants refuse to accept this reality. While they chase narratives and react to headlines, the disciplined minority positions for what's probable, not what's possible. If this analysis helped you see beyond the noise to the underlying patterns, subscribe for more systematic thinking about markets and human behavior. The next video will explore how to position for the structural shifts happening beneath this surface volatility.